just what I need. That'll get me to 12 cups a day. Maybe we'll have to get the price of coffee up. We'll all drink more coffee. What I thought I'd talk about today, 5 years after that unpleasantness that we call the financial crisis, the Great Recession of 2008 and 2009, is the state of the world economy. I'll focus my comments on the United States. It is the largest economy in the world. It drives a lot of the economies around the world. But near the end of the presentation, I will make comments on Europe and Asia as well. So this will be a broad survey of the economy and financial trends. So I'll try to leave some time at the end for questions. But I did want to play a 2-minute video at the end. Clark and Daw are two of the, I think, the most perceptive commentators on the financial world, and I'd love to share that short video with all of you. So, who out there has heard of Brown Brothers Harriman? Okay, a few. Well, those who know us think of us as the coffee bank. And in fact, if you look at the $1.5 billion of outstanding loans that we have as an institution to private companies, about 40 to 45% of that is in commodities, energy, metals, softs, but by far the largest sector that we support around the world is coffee. Now, for us, this is much more than about just lending to coffee traders and processors. It's about establishing relationships with leading business owners and families around the world who are doing the best possible business in this industry. We want to be advisors not just for supporting the loan side, but every company, and those of you who own companies out there all know, growth is just one part, and generating wealth is only one part of the equation. There are times when owners need to transfer their ownership. They need advice on how to do that. They need to transfer to family or partners or to employees or sell. You might have a roasting company that wants to acquire another company somewhere else in the world. They need advice on how to do that. We like to stand there and be that point of advice. And finally, we like to do business with really successful companies. And guess what? Successful companies generate wealth. And that creates challenges. And we're one of the leading wealth managers for leading families around the world. So we see ourselves as advisors around that whole cycle of wealth creation for companies. Now, one thing I want to leave you with, if you leave with nothing else today, is recognizing that Brown Brothers is really a different kind of a bank. We are a private partnership, a general partnership, and we're almost 200 years old. What that means, being a general partnership, is that I and my 39 partners, of the 4,600 employees, we have total personal unlimited liability for all of the obligations of the bank, and at the end of the day, that's about $6 to $7 billion. So in addition to the $750 million of capital that we have as partners in the firm, and there is no outside capital, there is no outside debt, that we stand not only with that capital, but our personal houses and cars and children. Well, don't take my children, but you get the point. We stand behind the company. And I would argue that the reason we're having a conversation at all this morning about recovering from the crisis, that the seeds to the financial crisis was laid in the fact that all of those investment banks decided to go public, Solomon, Goldman, Morgan, and guess what? They passed on the risk to who? The taxpayers. If they still were general partnerships and were personally at risk for all the decisions that were made in that whole stream of toxic assets that ended up all around the world, we would not be talking about a financial crisis or any kind of recovery today. Okay, so when we're trying to make sense at Brown Brothers of the economy and developments around the world, we do it through can you hear me? We do it through the lens of trying to help our clients, business owners, and individuals make decisions about how to position themselves with respect to those developments. In fact, what we're seeing, we think, is relatively positive. And you'll see toward the end of the presentation, we've actually have put up an asset allocation model that shows what we're recommending to our individual clients who have 10, 20, 50, $100 million to invest. We're telling, would you rather me stand here? Is this better? We're telling them where they ought to be putting their money and in what type of an asset allocation model. So I'm a pretty simplistic, we're 17 offices in countries around the world. When I think about the U.S. economy, I'm a really simplistic thinker. Because if you know what the consumer is doing, in really any economy, but in the U.S. economy, if you know what the consumer is doing, if you know what the decisions they're making, you know what's happening with 71% of GDP. So the 313 million Americans, the decisions they make drive the majority of what happens in the economy. So you have to ask yourself, given that, what are the inputs that drive those decisions and what impacts the ultimate effect on GDP? The answer to that question, oddly enough, doesn't lie in economic principles. It really lies in psychology. Psychologists tell us that when we make decisions to spend money, we're answering two questions. I'm sorry about this. By the way, I'm really happy as a banker to be in a wool suit today, and I think I may stay in it the rest of the day, maybe a little volleyball, swimming. If you don't recognize me by my arm, you'll recognize me as the wet banker in a suit. So anyways, so you're answering two questions when you spend money. One is, am I rich enough? Am I wealthy enough? Do I have enough assets to support the purchase? That's called the wealth effect. The other question is, do I make enough money? Do I have enough income? That's called the income effect. So a willingness and ability to spend is what drives that personal consumption. So developing an understanding of the drivers of that is important in knowing what's going on in the underpinnings of the U.S. economy. Well, for the vast amount of Americans, it is the housing market that drives the wealth effect, and it is the labor market that drives the income effect. So why has this recovery been so protracted and so long? Well, for the first time in a generation or more, the marginal income that comes into GDP has drains on it. And those drains are coming from two places. One is that there's deleveraging happening at the household level in the United States. I don't mean the federal government. The federal government continues to lever up, but the household level in the United States continues to delever. And the other thing is that the savings rate is going up. Now, Benjamin Franklin always said that a penny saved is a penny earned. But I'll tell you this, a penny saved is a penny that's not spent driving the economy. So those two things, money to pay down debt and money to pay down to put in your mayonnaise jar, those two things are drains on growth. So if you look at some of the factors, you're going to see that really, in the end, I think the durability is there for the recovery, but the pace of the recovery, because of these drains, has been slowed down. So let's look at some of the factors involved around these inputs. Let's first start. I'm sure a lot of you are familiar with a lot of this, but let's start with the housing market. So this is the average price of a house. Let's see, which is the pointer? Is it the top one? This is the average price of a house in the US, and you can see, and I'm going to push a button, I'm not sure what's going to happen. You can see that at the crisis, prices went down to where they were at the beginning of 2000, a huge loss of value. Further, this is the change, the year-on-year change in the value of a house. So you go to the beginning of, see, I knew I was going to do something wrong. If you go to the beginning of this period, now this was 2001. There was a recession in 2001. If you remember those September 11th, there were a lot of negative things going on, but the consumer actually did really well. Why? Because there was a 10 to 12% annual increase in the value of their homes. So is it any surprise that when things started to drop, that the economy stopped on an absolute dime? So if in fact the consumer was doing so well, what was going on? Well, people in the United States, they consider their house to be ATM machines. Cash comes out. As the price goes up, you get a second mortgage, you pull value out, and you could see at the Great Recession, that value just declined substantially. In fact, the rate of decline was something like 20%. But here, look what happened more recently. This is these August, September data points. The annual rate has been going up at something like 13, 15%. So that psychological effect, that wealth effect of feeling like there's value there is really important. Because even if you think about that when those prices fell, even if you had a good job, you didn't want to move, you didn't want to sell your house, you were happy with your house, the fact is that across the street, there were 3 houses that had been on the market for 14 months, cut the price 5 times, and they still weren't selling. So guess what? You felt poor, and you acted poor, and you were scared, and you acted scared. So the psychology of this whole thing has turned incredibly durably. So the wealth effect input that we believe, and I believe, is the foundation is really quite strong there. So if you not only look at prices, but look at the volume of activity, that too has turned durably, in my opinion. Existing home sales are up 62% from the trough, and you can see that new housing starts. Now, new housing starts are shovels in the ground, big multiplier effect. Those are up 86%. Now, obviously the absolute number, because you start pretty low, isn't that great, but the fact is that there is incredible momentum in the housing market, so the wealth effect, which is that first part of the flow chart we talked about, is in pretty good shape. So let's look at the other driver of personal consumption, and that's the income effect. Let's see that twice. There we go. So this is a quick snapshot of the labor market. It's the monthly net job gains. And this is from the payroll report that comes out on the first Friday of every month. And you can see a familiar pattern. Now, there's a ton of hand-wringing about this recovery right here. But look at that recovery from last recession. You talk about spotty. That's incredibly spotty. In fact, if you compare this period to period, it really isn't that bad a bad a recovery in balance. And in fact, if you look at the unemployment rate, it just came out at 7.4%. You had this steady increase over a period of time. Now, we wish the employment rate was higher, that the unemployment rate was lower, but in fact, the things are solid. The economy has added 7 million jobs since the recession. Would it be better if that absolute number was higher? Of course. But it's good shape, not spectacular shape, but good shape. So when you look under the hood of the jobs, and you sort of ask yourself, all right, I look at a trend like that, and you sort of ask yourself, all right, what's going on? So, oh, and by the way, that's the unemployment rate overlaid on top of that net change. So, the thing I love to watch when it comes to the employment figures in the U.S. is the initial jobless claims. Those are the people going for the first time, they've lost their job, and they're getting unemployment insurance. This $400,000, a 400,000 job, that claims, that's a really important litmus test, because if you're below that, that means there's downward pressure on the unemployment rate. There's one little blip right there, 1 week, since all the way back in, I think it was October 2011. Everything has been downward pressure except for 1 week. So let's play a little game of trivia. Who knows what happened on that 1 week when initial jobless claim was over 400,000 claims? Hurricane Sandy. One natural event, natural disaster, caused the unemployment rate for the whole country to blip, those initial jobless claims. Incredible how one situation in one part of the country can have that big an impact. More encouragingly is that the jobs added in the economy in the U.S. are actually pretty broadly based. I'm always suspicious as an amateur economist about rate trends that are going in one direction. You say, well, is there some factor that's overcoming some other trends that we need to look at? Well, the fact is, if you look at manufacturing, construction, service, really all of them are relatively, those are private sector jobs, are positive. What's the one big outlier? That's government. And you say to yourself, but the federal government's spending money like drunken sailors. How is it possible? Well, that's because of what's going on at the local, state, municipal level. Those governments have to balance their budgets by statute, so they have to cut when they need to cut. There's some softness in the number from the federal level given the sequestration, but still the numbers are overcome by what's happening at the local, state, and municipal levels. So if you think about the wealth effect, looks decent. The income effect through the labor markets, it looks pretty good. Another dynamic of that flow chart is this chart right here. Another one that I really like to look at. Okay, what is this? We're talking household debt to disposable income. I think most people are used to talking about total debt in a country versus GDP. Well, GDP is the equivalent of household debt and disposable income. The GDP would be the equivalent of disposable income, and the total national debt would be the household income. But you could see, and this goes back to the beginning of the 1990s. We averaged about 86% debt to household income. That includes mortgages, so there's real debt in there, and that is a sustainable level. But you can see what happened in the run-up to the Great Recession. Borrowings went up to 130% of household income. Now that is unsustainable. Of course, you can see crisis happens and people start to pay down debt. That represents, after the crisis, about 25% of household income is going to pay down debt, 25%. So the economy is growing despite the fact that people are pouring money, paying off their credit cards and paying off their second mortgages. The other dynamic is savings, and this is a really volatile chart. This is the savings rate going back to about, I think it's 1958, which is very typical. Brown Brothers loves to take a long-term view. And that blue line is a 3-year moving average to kind of settle it out. But what's really interesting here is that in the 60s, the 70s, and 80s, we were taking 10 to 12 cents of every dollar and putting it in the mayonnaise jar on top of the refrigerator. Now, that doesn't include 401k and pension. That's just mayonnaise jar. But you can see what happened down just before the crisis. There was a whole generation of people who were saving 1 to 2 pennies out of every dollar, only in the mayonnaise jar. It's a pretty paltry little jar. So, as you can imagine, what happens is the crisis hits, and guess what happens? People are scared, they start saving again. Again, a penny earned is a penny saved is a penny earned, but it's not going to drive the economy. So despite savings, despite deleveraging, the economy is still pushing forward. So in the long run, those are all good trends, but in the short run, it's a drain on GDP. So how does all this end up with gross domestic product? So third quarter GDP was 2.8%. The recovery average 2.2%. Not great. Generally, recoveries from recessions in the U.S. are V-shaped, nice big bounces. But the fact is, there was no bounce this time. And it's been a slow slog and continue to be because of the drains that we just talked about. So I draw your attention to something about the makeup of GDP. Personal income, personal consumption is the most important driver. And of course there's business spending, and there's net exports, and there's government spending. All those go to make up that full GDP. But it is personal consumption that's 71%. So when you look at, these are all the quarterly additions to GDP, and you say, okay, well, what's business? Business spending, you can see, is actually pretty volatile and has been a drag, and that's for capital expenditures, plant and equipment, infrastructure type spending. And here's net exports. People think that the export market, obviously that's dependent on what's happening in other countries, but the exports in this country really haven't been particularly additive over a period of time to GDP. And finally, what I think surprises people most, if you look at government spending, generally over this period, starting 2010, a drag on GDP. So it's all about, and I really love this little effect. Oh, I love that. So it really is all about personal spending when it comes to GDP. Okay. So in response to all that, you say to yourself, given all these things, Jared's saying that there's things are looking pretty good and a bunch of this, why is it Given that things are relatively positive, why is it that the Fed continues to give us an accommodative monetary situation, driving cash into the system? Why is that going on? Why aren't they seeing all this stuff? Well, the fact is, if you look at the futures market, and there's the Fed rate, there's the Fed rate, so a little bit, and the futures market doesn't even have us, by the beginning of 2017, doesn't even have Fed funds over 2%. Well, I think there's basically three reasons, and we know that recently the Fed said they're going to keep putting their foot in the gas, $85 billion a month purchases into Treasury. Well, I think there's three major reasons why the Fed has pulled back from the tapering that was announced. The first is there's a long-term trend which I think is pretty concerning, and that's the labor. Okay, well these are the government purchases. You can see it's estimated to be that's the balance sheet of the Fed. That's how much debt is. That's how much stuff. Now this video we're going to play later has to do with quantitative easing. This isn't just easing. This is a rolling around on the beach and falling asleep. That's big dollars. You look at where the balance sheet of the Fed was at the beginning of this all. That's how much money has been printed by the United States government. So, but there's some things that concern the Fed. They concern us, the Brown Brothers, and they concern the Fed, and they have to do with the labor market. Here's the labor participation rate. These are people of age to be working that are part of the labor market. You can see it's been around 62%, but there's things going on there that are of concern. You can see female and the male participation rates. This is sort of interesting. People talk about the development of the U.S. economy after the Second World War, the big shift from military to a private economy. Well, let me tell you, I think that what really drove the economy during the late 40s, 50s, and 60s was the female participation rate. You think of all that productive capacity that went into the economy. It was 30% of half the population started to add to the economy. I think it was an incredibly compelling part of what drove that growth. But this 60% actually hides some things, and the rate where we're at 60% now, that's about a 35-year low. So that participation rate, I think, is concerning and makes you wonder. All right, well, what should we be comfortable with the unemployment rate the way it is? Okay, so that's sort of the first reason. The second is, and here's, you sort of ask yourself with the labor markets, how many absolute jobs are there in the United States? You can see that we peaked at about 55 million jobs, and there was loss of jobs after the recession, but we sort of flatlined. We're sort of flatlined at 55, 56 million jobs. There are not a lot of new absolute jobs being created, and you know, some of this is maybe more baby boomers retiring. There may be a number of reasons that this is happening, but these are things that stay the Fed's hand when it comes to making decisions. A second reason that the rates have been left is that the Fed has actually succeeded in tightening the economy without doing anything with their bond purchases. Look what's happened to the rates since in May Bernanke announced that they were going to taper. They haven't tapered yet, but the 10-year Treasury is up 100 basis points, 30-year mortgage is up 100 basis points. Talk is not cheap. All Bernanke did was open his mouth and he tightened the economy, but they're still buying bonds to beat the band. The last reason, and the final one, really has to do with the schedule of policy, government policy in the United States. There are several things in the balance here, and let's just go right through that. But let me just talk through it. There's the debt ceiling that's got to be dealt with. There's the affordable health care, and there's the budget. All that have to be dealt with. And the Fed does not want to complicate this volatile mixture until after those things have been dealt with. So people ask Brown Brothers, they say, all right, what is the new normal of interest rates? What should interest rates be? Where they're going? So if I try to channel my inner Bernanke, I don't recommend you doing this at home, but if I channel my inner Bernanke, I say to myself, there must be a relationship between real interest rates and inflation. That's basic economics 101. And if you look back over time, the real Fed rate has been 1.7% before inflation. All right, so if you take 1.7% and add on the current inflation rate of 1.5, you get about 3.25%. And the current rate, the Fed funds rate is about 0.25 or less. So we got 3% to get up to what we would define as normal. And I think that's where it's going. I spoke to our emerging market foreign exchange folks yesterday. They think that there actually is going to be a tapering that will begin at the end of the first quarter, that there'll finally be an actual jump in those real rates. So we're looking at maybe first, second quarter when that tapering actually will begin. So I actually think a higher level of interest rates is actually good news, because there's this feedback mechanism that's been broken. Normally the financial markets will look at the short-term rates and they'll either see financial distress or financial opportunity in where that rate is set. But with the Fed throwing money into the economy, that whole mechanism and feedback has been broken. And I think that if we get back to a point where savers can finally actually earn money, and there's a mechanism where rates actually reflect what's going on, I think that would be a good thing. Let's talk quickly about the European economy. We're actually sort of optimists about this. We think there's a turning of a corner. Now it's a really big corner, right? And I think that you can see the financial crisis right here, big scary red line. And actually, there were 6 terrible quarters of recession. Anyone who's gone to Europe knows that this feels like just a long slog. But the fact is, that's positive. The GDP, or the Euro GDP just came out at 0.5%, so you have 2 quarters of positive in a row after 6 quarters of negative. So I think it's a little presumptuous of us to say that things are better, but the fact is that there is a turn. U.S. is stronger. The support for that is there. I don't think it's going to come rolling back to life, but I think that there's some positive signs. So let's just talk quickly, and by the way, this is leading economic indicators for Europe. That's over 0 finally. Finally, there's some positive sentiment underlying and creating a little durability to the turnaround. Okay, China. So last time I was here 2 years ago, I put up a whole bunch of statistics about how much China represented of commodity inputs. They buy over half the cement and half the copper and most of the steel. It's unbelievable the kind of inputs that they consume there. And you can see what happened, the result of the financial crisis in the West. And it's all sort of clear here. But the question is there going to be a hard landing or a soft landing in China? And I think you have to go back to the 5-year plan that they're under now when you think about that. A lot of you do business in China and think about it a lot. I think that this 5-year plan that the government has and has had in place since after the war, those 5-year plans, they actually do it. They set a plan and they actually do it. They write it down. And if you look at all the 5-year plans since the Second World War, they've basically done them. The 5-year plan we're currently in was done in 2010. They stated that the biggest problem for the economy was reliance on the West. They paid for it there. But they said that the 7% was the rate at which they felt that it was, in fact, sustainable. So you can see the glide path is, in fact, to about 7%. Now, I know a lot of people say the statistics coming out of China cannot be believed. But all I can tell you is, and I share those sentiments, but all I can tell you is our analysts in New York spent a lot of time looking at the underlying statistics. We're looking at the energy production, energy consumption, actual freight loading, what's going on in local bank markets. All of those underlying trends, they actually are supportive of where we are right there. So we do not think there's going to be a hard landing. All right, we're almost at the end here. I don't think I'll go over too much. How long? I'm dead. Okay. We're not going to talk about that. All right. In summary, we think that the housing and labor markets are going to be supportive for the GDP and the health of the U.S. economy. It's all about personal consumption. Watch those numbers. And we think the Fed is going to keep this going until there's more clarity on some of the pressures we've been talking about. We think the Eurozone's turned the corner and that the pace of expansion, 7 or 8% is what we're going to see out of China, and that's going to be good for everyone. So the last thing I wanted to do, just quickly before the video, our bankers in New York in the commodity write a quarterly publication called the Commodity Markets Update. It's available on our website, but I have a number of copies that will be handed out at the end. That's written by the bankers in the front line. They're the ones who are seeing the trends firsthand, and their insights are, I think, worth reading. This issue happens not to have anything about coffee. We generally, because we're sipping coffee, have some article on coffee. The big article in this one is about the oil production in the Bakken in North Dakota that's changing the face of energy in the U.S. And will change the face of geopolitics in the world. But that's available as you leave. Now, finally, Clark and Daw. This is this terrific economic market commentators. If we could watch this quick video. Thank you very much for your attention. Look forward to, if everyone has any questions or is looking for a good left cut, I'm going to be around through Sunday morning. Look forward to chatting with everyone. Thank you very much.
Well, this is just a few simple questions.
Simple questions? Yeah. How simple?
Well, they're theoretical.
Theoretical. I can deal. Yeah, okay, we can deal with that.
Yeah.
I mean, don't hold me to the answers, but
why not?
Well, because I'm an economist and I can think of a different set of circumstances under which my responses might vary somewhat.
And everything's connected to everything else, isn't it?
In economics, I'm afraid that is the global fear right at the moment, yeah.
Now, right, there's a lot of uncertainty in world economics, isn't there?
There is a great deal of uncertainty and a lack of confidence.
Yeah, and there's a lot of talk of quantitative easing.
Quantitative
easing,
that's a term
we hear all the time.
That's a term you hear a lot at the moment, yes.
Yeah, what exactly is quantitative easing?
Well, I can answer this because actually we're advising a couple of governments about this right at the moment.
And what are you saying to them?
Well, perhaps I should just take you through what we're telling them to do.
Yeah, sure.
I mean, I won't go into a lot of detail,
no,
that'll be indiscreet, but this will give you an idea of how quantitative easing works.
Yep.
Take printer out of box and place on table with the out tray facing the window.
The out tray facing the window.
That's right. Load paper into the paper receptacle and place currency on glass tray F.
Right.
Check alignment by printing out a test page.
Right.
Go into copy settings and select double-sided and the number of copies you require.
How many would you suggest?
In the case of one of our clients, it's 80 billion, 120 billion in the case of another client, and one client wants 1 trillion of these things.
Can you get printers to do that?
No, you can't. You're going to need a bank of them. I mean, it's a multi-printer
big
job.
Ones,
yeah, big industrial strength.
Yeah.
Big like a Bofors gun, all facing the window.
Yeah.
Once you've ascertained that you have the alignment correct, you alert the banking sector, open the window, and press copy.
And stand well back.
Yes, you've got to stand well back because they can create a bit of a vacuum while reaching cruising height.
Whereabouts?
In the super fund industry very often.
And you'd have to consider the wind direction too.
Oh yeah, you don't want to be doing this upwind.
No, because you'd get covered in pretend money, couldn't you?
Covered in what?
Pretend money.
No, this is not pretend money. This is real currency we're creating.
But aren't you just printing it off? I mean, these are photocopies, aren't they?
Excuse me. Dave, this is not going to work. Because I've just explained it to a bloke and he saw through it straight away. Are you in banking?
No.
No, he's not even in the banking racket. Okay, I'll try that.
Try what?
Have you ever heard of Rumpelstiltskin?
No.
Good. Now we're getting somewhere. Pull up a chair. I'll tell you a tale.